Which is the better dividend stock to buy for 2023? McDonald's or Domino's? I'm going to answer that question in this video. You're going to have the answer by the end. So let's get right into it. McDonald's and Domino's quarterly revenue growth over the last 10 years. I'm looking at on the top we have McDonald's, and McDonald's has been relatively stable. That is until 2020 when restaurants were forced to close to in-person dining. So McDonald's revenue took a hit downward and then rebounded stronger than ever before. And then now it's kind of fluctuating a little bit. Whereas Domino's had the opposite effect. Of course, when restaurants were closed, Domino's thrived as people ordered pizza way more than usual. And even before that, Domino's was growing revenue closer to 10% over the last decade on a quarterly, and it was growing more robustly than McDonald's was. So revenue growth, certainly Domino's has the advantage in this regard. The next metric I have here is a really interesting one, and that is operating profit margin over the trailing 12 months. And look at the massive difference in their operating profit margins. McDonald's operating profit margin 43.7% in the most recent trailing 12 months, and Domino's at just 16.5%. And longer term, McDonald's has had a huge advantage over Domino's in terms of the operating profit margin. And this could be one reason why sales growth is slower for McDonald's compared to Domino's. One way you can boost up sales growth is by willingly accepting lower profit margins, and that could get sales going. But McDonald's has chosen to be happy with flat-ish sales growth and very robust operating margins, and so the advantage goes to McDonald's here. The next thing I want to look at when determining which one is the better dividend stock is earnings per share growth, because dividends are paid out of earnings, and if you don't have earnings to support dividends, then those dividends are unsustainable. And both Domino's and McDonald's show very solid growth in earnings per share between 2014 and coming now 21, 22. Excellent growth from both McDonald's and Domino's. If I had to give an advantage here, I would give the advantage to McDonald's just because of the near-term pressure that Domino's is facing right now. They're more constrained in terms of earnings per share than McDonald's is. Domino's is having a very difficult time hiring enough drivers to support the growth as economies have reopened, and Domino's has been more conservative in increasing prices on customers, and that's also constraining profit margins, which are going to constrain earnings per share. Meanwhile, McDonald's rollout of its digital capabilities has grown really well. Customers are really liking ordering McDonald's on the app, ordering McDonald's for delivery, ordering McDonald's for online order and pick up in store, and that's really good for McDonald's profit margins. If customers are ordering on the app, that's one less person that McDonald's and its franchisees have to hire in order to take your order. So that's going to be good news for McDonald's prospects over the next 5 to 10 years. So advantage slightly to McDonald's here. And the next metric, of course, we have to consider if you're thinking about which one is a better dividend stock to buy is the dividend yield. And in this regard, McDonald's has the advantage with a 2.14% dividend yield compared to Domino's 1.27% dividend yield. Moving on to the payout ratio, which measures the percentage of earnings a company pays in dividends. And in this metric, you want to see the lower, the better here. So that means if it's lower, a company could experience a moderate decline in earnings per share and still pay its dividend without tapping into savings or needing to borrow to support that dividend payment. And Domino's has the advantage here with a payout ratio of just 32.9% compared to 69% for McDonald's. And the final metric I will look at is valuation, comparing McDonald's and Domino's price to earnings ratio and price to free cash flow. You have Domino's on in the orange at a PE of 35.5 compared to a PE of 24.6 for McDonald's, and Domino's at a price to free cash flow of 34.6 compared to 25.93 for McDonald's. So in both regards, McDonald's stock is considerably cheaper than Domino's stock right now. So to answer the question, which one is the better dividend stock to buy for 2023? I'm going to say McDonald's is the better dividend stock to buy for 2023. It's considerably cheaper than Domino's, and the near term headwinds are not as severe for McDonald's as they are for Domino's. The labor shortages are real. Domino's management has been complaining for several quarters that they are just having the hardest time finding enough drivers to staff their locations. All right, so that's all I've got for this video. Thank you for watching, and I will see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.